here on board now Nitin Raheja, who's the Executive Director, who's the Head Discretionary Equities, Julius Baer Wealth Advisors, who's joining in to weigh in on how the market is shaping up and how should one look at playing this market. Hi Nitin, good afternoon. Thank you so much for taking the time out for us.
Good afternoon.
Nitin, right off the bat, how do you look at this market? How should one play the market now? Now, see, the entire tariff news has been played out. We have already digested the pain coming in from tariff. The earnings downgrade is already priced in. We have corrected fair bit, and there is limited downside risk now. How should now one look at the markets? How should one navigate through it?
So, you rightly sort of ascribe to the fact that a lot of the bad news, so whether it's with respect to the tariffs and the uncertainties of the tariff, plus the earnings downgrade and the cyclical slowdown that we are seeing have sort of been discounted to a large extent. I think, however, what we have not discounted is really what could be the second order impact if, because of this flip-flop on tariffs, the US economy were to slow down. Because don't forget that while we all looked at the first order impact of tariffs on individual industries, but a slowdown in the US economy, or if it sort of, potentially gets into a short recession, and its impact on the IT sector, which is, hugely dependent on the US economy and employment trends and commensurately consumption, which already is facing challenges. So I think that's yet an uncertainty which is hanging out there, as such. Our own belief is that a large part of the correction in the large cap space, especially if you look at the headline Nifty 50, has played itself out. We believe that, around about a 22,000 level, there is very limited downside from there for the Nifty. And so in the short term, we believe it will trade in this range. It will keep seeing rallies and then, cool downs and so on and so forth. But in the mid and small cap space, we do believe that there is yet a valuation pain that has to be yet completely be seen. But having said that, also we are not seeing any clear themes or trends in the short term play itself out. So I believe this is going to be a bottom-up market. This is going to be determined by the result season in terms of what stocks and which companies will be winners.
Hi Nitin, good afternoon. This is Shrishti also joining in. Yes, uncertainty still prevails in the markets, but Rohit, if someone has to take a longer term view, say over a year period of time, help us understand that which pockets are looking interesting to you right now. Like you highlighted, the financials is one of the safest bets in this particular market. But other than that, any pocket which is giving you the valuation comfort?
So besides financials, if you really look at it, I think you probably see some amount of valuation comfort play out in the so-called infrastructure construction stocks, which have corrected quite dramatically in this correction that we've seen over the last few months, where valuations have sort of become attractive. We see some part of that also in sectors such as cement, which are all local building material oriented sectors. But however, there you also have to be very wary. One of the big trends that we have seen in the recent past is the increase in competitive intensity across sectors, which means that margins are going to be under pressure for a lot of these companies, especially in areas such as building materials and so on and so forth. And that could mean that any scope for disappointment could be sold down. But cement is a space within that which we think offers some degree of comfort. I think the EMS space has corrected quite a bit, and there is something which we could see, continued growth happening over the next few years.
Nitin, interesting that you mentioned EMS space because EMS, while India is a big beneficiary for EMS space, in fact, with the government push, India is on its way to become a big major manufacturing hub as far as the EMS space is concerned. But having said that, there was also news on the tariffs as far as the EMS space is concerned. Would you be concerned about that?
Look, a large part of what we see in most of the EMS manufacturers is domestic orientation. towards that whole domestic market. So I think, and then on top of that, I do believe that when we talk about tariffs, we've got to a stage where uh, we were, the kind of tariff numbers that were set out and then rolled back. So I think what will probably follow over the next few months is some sort of bilateral trade deals or tariffs at far lower levels than that happened. So in that sense, I think the worst fears of tariff have already been built out there, and what will probably come is going to surprise. So I think EMS will continue to do well.
Nitin, in the EMS space, do you get that valuation comfort at this point in time, or do you believe that the opportunity size is this big that one should start looking at it, and valuation could take a bit of a backseat? And along with that, Nitin, since EMS, do you believe that the China plus one story is too big to play for the Indian players as well?
So when you look at that, I think within the EMS also you have to be very selective. And there are players who have seen a fair degree of correction, which when you look at them in relation to the kind of growth numbers that they are talking about happening, have started to look attractive. It's not a broad space. What is pretty interesting is at the present moment, there is no broad sector space you could say that, oh, this sector looks interesting, and you can look at all companies. Within each sector, there are companies that will need to be looked at, which have business plans which are more domestically oriented and backed. But having said, to answer your China plus question, I think clearly the developments of the past few months have actually only strengthened India's case for the China plus one story to happen. Because I think clearly what is happening is India is being seen as a non-threatening, more on the table negotiating player. And hence, we think that that sort of gels down well with the kind of approach that we are seeing from the West. So I think the whole manufacturing China plus story, it presents a great opportunity today in this scenario for India to put its hat into.
Yeah, right, Nitin. Also, while domestic consumption, domestic facing companies is a common consensus now, uh, I can see that you're bullish on domestic consumption as well. Within the consumption basket, because it's a big basket, what are the pockets of value, or what are you bullish on the themes, whether it is, the airlines, or is it the hotel space? What within the consumption basket are you positive on? Is it the discretionary end? What is your bullish theme?
So within the consumption basket, what we are looking at is clearly a on the premium side. There, while we've seen a great deal of growth happening in premiumization, and there is some element of pricing barriers that are starting to come up as far as demand, and hence some of the stocks in that sector have seen a correction. But clearly, what we are seeing as far as the whole experiences-based economy, which is plugged into by airlines. Now, if you look at it, that like you talked about, what has happened in the airline space is that the sheer capital deployment that is required and the lack of appetite for risk capital to be deployed on the part of Indian corporates has meant that there has been a consolidation, and that has given huge pricing power. So I think I don't see anybody coming in a hurry, more with the problems of Boeing also in terms of delivery. So I think airlines will continue to show great resilience through this. I think the hotel industry will continue to show good growth. You could see an intermittent. So what I see in the hotel industry is a lot of growth being driven by supply rather than pricing, because I think pricing is starting to see some sort of barrier. So that's one element. Even within retail, I think if you look at, say, for example, organized retail in terms of malls, I think you will see that doing well, because again, there are very few pan-India malls that are there, and there has been a consolidation out there. So I think retail will come back. The other element that I see happening is there are two or three factors that I see where the bottom K of the retail domestic piece, which has been lagging so far, should come back. One is this whole tax cuts that has come on the part of the government in the budget. The second is the revival in rural. And the third element is that, the pay commission recommendations that will see an increase in salaries for government employees over the next 1 year. All of this should see, as we get into the next festival season, a bounce back of the bottom K of rural. And I think that's the other part of the pie that looks interesting.
Nitin, since you have been constructive on the markets and you did highlight some of the sectors that one can start looking at or where you have the comfort level, but help us understand that amidst this sector churning, which pockets do you believe will not participate in the rally or the recovery that is expected?
So I think one of the key elements that we are seeing is that, like I mentioned, competitive intensity in a number of sectors is going up, right? So if you take paints, we saw competitive intensity go up and we saw multiple derating happen. If you see wire cables, we've seen the entry of two very large players into that segment. And I think there again, competitive intensity is going up. If you see the whole quick commerce space, competitive intensity is very, very high. So any sector where you are seeing more new players enter and the multiples are yet elevated are the kind of sectors that I would avoid. And I've given you an example of 3 of such sectors.
Nitin, I want to come back to the first thing that you mentioned, that amongst your bullish themes, financials is something that you're bullish on. Now, within the financial basket, do you see a lot of valuation comfort coming in on the PSU pack? Because that's the one that's been really leading the rally from the front, as we can see. Also, with the rate cut coming in, PSU banks are big beneficiaries of that. So, do you see the PSU pack within the financials? Where do you see value? The PSU pack, the private banks, or the NBFCs?
So I think the first phase of the rally, in my view, is going to be driven by NBFCs, because when you see an interest rate cut, the obvious beneficiary is the NBFCs who are actually borrowing from the banks. So you first see the cut in the lending rates and then followed by deposit rates. We've already seen a couple of large banks proactively take a stance and reduce deposit rates. We've seen the largest public sector as well as the private sector bank doing it so far. So I think the first beneficiary is going to be NBFCs in the next, say, 6 months. And then as the impact of these rate cuts starts percolating down to deposits, you are going to see the whole banking or the private banking space, as well as some of the top PSU banks participate in it.
All right, so we'll watch out for that. But Nitin, with this, we let you go on that note. Thank you so much for taking the time out and speaking with us and sharing us your perspective on the markets.
If you like this video, then like, share and subscribe to ET Now.